beyond the white fence. Teamwork like this is rare to find, helping you leave all your doubts behind. They talk about homes and talk about life, cutting through the stress and the buyer's strife. With every word they light up the spark, guiding you through when the road feels dark. Jeb and Josh, they're paving the way, dreams to reality, they make your day. From the first hello to the closing sign, your journey to home is looking divine.
All right, welcome to another week of the Educated Homebuyer live with Josh and myself here on Fed Wednesday. We're going to talk about the Fed. We're going to talk about mortgage rates. We're going to talk about housing. We're going to talk about life and have fun while doing it. Josh, welcome. Welcome.
Do I look like I've been punched in the face repeatedly?
You look like that every week. This week is no different.
They're not going to be happy with you speaking badly to me like that.
You know what? I'm going to start. Listen. So Josh informed me prior to coming on here, looking at my charts, that I did not update the local charts in there, and I didn't. And so I was trying to do it, and I don't know.
GPT left you hanging?
GPT decided to reformat the whole chart again. Instead of arguing with this thing, we're just going to have to go over it. I don't have time to argue with GPT right now. So we're just going to have the information. We're not going to have
that would be the more entertaining show if we just turned the camera on you and watched you argue with GPT for the next 20 minutes.
Listen, it could happen. It could happen. And I mean, it might be like, might have to get the police involved. There could be abuse happening here.
People would think less of me if they hear the things I've had to say to GPT for its
I think they expect it at this point. I'm not sure that they think any less.
Okay.
Anyhow, so we're here. We're, the Fed cut rates. We're going to talk about what that means, but we're going to talk about where interest rates are headed. I know a lot of people out there wondering, should I lock? Should I refinance? What's the next step? And tonight we're going to discuss that. While we're going over charts, do us a favor. Let us know where you're watching from. Start putting your questions in the chat. It's always helpful to kind of just flow right out of the charts and be able to answer your questions so that there's no slowdown in the show and that everybody's questions get kind of go in order. But with that said, Josh, are we ready to look at some charts, my friend?
We're as ready as we're going to be. The best part, Jeb, is I tried to bring up a new chart, and that heavy strain on the internet froze you there. So hopefully you didn't say anything brilliant in the last
brilliant. I've never said anything brilliant. All right. So this week we saw inventory actually increase. So last week we were asking, is inventory going to start going down from here? So this week we actually saw a noticeable jump. Inventory back up to 860,000 home. That's about a 14,000 home increase, which is somewhat rare for this time of year. But with that said, we're still not above the peaks of this year. But if things continue like this, we could definitely trend above it. But at this point, we're sitting 21% above where we were last year. Last year, 713,000 homes. This year, 860,000. This is where the chart's missing. If you didn't know,
if you didn't know what a missing chart looks like, this is it.
Yeah, so Orange County this week, we dropped to 4,625 homes. The number there on the screen is actually incorrect because that's from last week, but it was a 2.27% decrease week over week. So we decreased about 2.3% week over week in inventory. Huntington Beach sitting at 267. That's a 2.62% decrease week over week. So both decreases, both in Orange County and Huntington Beach. I think there's probably the peaks in for both Orange County and Huntington Beach for this year, and likely to continue to see the numbers trend down. Maybe not in a linear fashion, kind of bouncing around, but I think the peaks are in. With that, new listings aren't ready yet. So we're coming into active inventory. So again, this is calculated risk. Taking, what I like to look at, Josh, when I look at this chart is where we were in 2019 versus where we are today. So year over year, you're going to have increases in active inventory for most areas out there. Grand Rapids, Michigan is actually still down year over year, but the majority of places out there are still up or are up rather. But when you compare it to 2019, you still got Albuquerque, which is, way off. New Hampshire's way off. Raleigh, San Diego, some of those are down compared to 2019. And then you see areas like Jacksonville, Florida, Phoenix, Dallas, Fort Worth, Charlotte, posting noticeable gains versus 2019. So that means you probably have more active inventory out there, more options as a buyer, which is a plus. Taking a look here at new listings. So new listings down year over year. If we take the wrong, so new listings slightly down year over year. But when you take the rolling average, the 90-day rolling average, we're still above where we were 23, 24. New listings again.
Hold on, Jeb. Can we go back? I got a question for you. You and I did not talk about this off air. Steve Thomas put out his report this week, and I know you formatted and shared it out with your audience. But one of the things he was pointing out is that last year, when rates dropped, there was an appreciable spike in demand.
Yeah, you can actually see it on this chart here, or inventory on this chart here, not demand, but new listings. You can see that spike. Yeah.
It's not a complete echo of last year. We are not quite as low as where rates went last year, but we're also hoping. Yet is one part, but even if they don't go last year, what is your, I guess we'll get to your charts in demand, but it's not like people freak out when you say, hey, when rates drop, you're going to see an increase. Oh, no, they're not. No one can afford. It's not going to make a difference, but we see it. It's a 10 to 15% increase in demand. So it takes us from very low levels to low levels. So it doesn't spike, but it absolutely changes that equilibrium, because what we've been talking about here, the listings on the market are building, not taking them off as quick.
Yeah, no, you froze. I mean, you're freezing. How do you run a business like this? This is incredible. But anyhow, so, I mean, to go back to your question, I will tell you, I've seen a noticeable increase in activity out in the market. Properties that were sitting on the market for a period of time, offers now going under contract. I mean, I called on one today, 13 offers on it. Things are moving. There are buyers out there off the fence here with the move down in rates. And I mean, is it ironic that it happened at the same time rates? I mean, possibly, but my
time of year when demand is usually diminishing.
No. I think rates are definitely playing a part in it. Doesn't mean there aren't still opportunities out there, still deals out there in some markets. It just means, hey, listen, that tick down from 6.5-ish, 6.6-ish, where rates were 6 weeks ago, down to 6.1. People were getting rates under 6%, for conventional, definitely in the fives for FHA and VA. And so that helped some buyers get off the fence and get in the market. So definitely an increase. And I think depending on where rates head, which we'll talk about in more detail, I think you could see more of that. New listings, again, just compare it to 2019. I'm not going to leave the chart here and go over this whole thing, but you can see most areas are still down considerably new listing wise when compared to 2019. The average is almost 17% down in most markets out there. So weekly pending sales, again, this looks very similar over the last couple of weeks. It's still above where we were in last year, but depending on what rate, what happens here, you can kind of see in November, Josh, you see that noticeable spike there in pending sales. And that's, that had to do with lower rates. People still out there having a low 6 handle on rates were able to take advantage. And therefore you saw that spike in pending sales. Depending on what happens this year, you may or may not see that spike, but either way, we're still ahead on both total and weekly pending sales. But it's all starting to blend really, really closely together. It's all looking very, very similar to what we saw last year. Price reductions, 41.5%, essentially flat week over week, I think 3 weeks in a row. You can see here, 2022 kind of saw an increase at the end of 2022. And at the moment, if we stay flat here, we're going to be under where we were in 2022 on those price reductions. But again, it's less inventory on the market typically this time of year. You have an increase in buyer demand because of lower rates. My guess is you've probably seen the peak for price cuts, but we will continue to monitor it. This is just a year-over-year change in home prices, looking at all of the quote-unquote major indexes out there. And you can see it ranges from essentially flat to somewhere in the mid 2% range, depending on which we're not seeing noticeable drops in the median home price out there, which is to be expected. Anything you want to add on that, Josh? Looked like you wanted to say something.
No, the chart is always interesting to me. It's going to converge back to zero here. Rates are going to tell the story. I know that triggers some people that they're going to hear that rates and improving affordability. If we stay lower, line.
This is me banging my head against the wall because you keep.
I wonder what Josh said.
Just banging my head against the wall. Like how I don't get it. So the big news, the Fed lowered the Fed funds rate, not interest rates, the Fed funds rate. So look at that headline. That is misinformation to some degree. And that's where, people take it and run with it and say, Josh, I saw that the Fed dropped interest rates 25 basis points today, 0.25%. Can I get it? And Josh says, what are you talking about?
Jeb, I got a message, and I won't confirm or deny whether it was a listener to the show that asked, I saw that rates dropped to 4.25% today. How do I get the 4.25% rate?
Fair enough. That's classic, actually. That's a good one. So we saw some change in verbiage here. Josh, I don't know if you want to read this, but the easy way to look at this is anything that's in red was essentially taken out of the Fed's commentary. Anything in blue was added into the commentary. So they make changes pretty much every single time. Sometimes it's just a word here or there. This one has a little bit more information in it. Or
the last few have been very minor changes. This isn't a lot, but it's a lot relative to what we've seen recently.
Yeah, so I don't know what you want to do with this. If you want to read it, if you want to take it with a grain of salt and move on.
If you're all that interested in it, go look it up online. It's not that interesting. This is a little bit more interesting. So from the press conference, here's probably the 5 most important quotes for you, the educated home buyer. What Powell said is, I can no longer say the labor market is very solid. That was pretty much the gist of the changes in that previous slide. He said a 1/4 point cut in itself won't make a huge difference to the economy. It's not just one action, meaning it's not just one action that would make a big move to the economy. So they're saying this is a pretty minimal move, and we'll see where we go from here. There is no risk-free path, and that is a reference to the fact that they did this because the job market is weakening, but at the same time, inflation, everyone believes, due to tariff-driven inflation, has ticked up. He followed up with inflation will move up this year because of the effects on goods prices from higher tariffs. That will be a one-time effect. Our job is to make sure that happens. So he's saying, hey, we're cutting, but we're not going to go so aggressive that we're going to let inflation get out of control. When our goals are in tension like this, meaning inflation higher than they want, job growth weakening, our framework calls for us to balance both sides of our dual mandate. With downside risk to employment having increased, the balance of risks has shifted accordingly. So in plain English, he comes out and says, we think the risks to the job market are more important than the slight uptick in inflation due to tariffs. The dot plots here, probably the most interesting thing there, Jeb, is do you want to tell them why we have this one little lone blue dot way down at the bottom of the chart there for 2025?
Is that our new friend?
That is our new friend Mirren. He is a little out of step with his compadres there on the Federal Reserve.
Hence the reason he might have been put into the Federal Reserve. What do you think?
Yes. He could be the next Fed president at this rate.
Well, I think it's something important before you dive into this, Josh. There's 8 Fed meetings per year, and there's 4 times per year that they actually put out the dot plot. So this is the last one. No, this is not the last one we'll see this year. We'll see one more this year.
There's only 2 more meetings. I don't think we get another one because
this is for the 3rd quarter. I think you'll get one for the 4th. No,
so because there's only 2 meetings in the 4th quarter. You're right.
I think you get one. I think you get one more at the very end of the year. But either way, that's why this is important, because it gives direction as to what the Fed is thinking. Right? The Fed comes out and they there's a 1/4% drop or whatever. And then there's commentary that comes out after the fact. You get the Fed minutes, a month later on what was said. But this puts it in very plain English as to where these members expect or think that Fed funds rate will be based on, 26, 27, et cetera.
And I think, did he mess up on his chart here where they both say June at the top? So it should be June and September. So
yeah, I was actually confused by that when I was looking at it earlier.
So the blue is September. Our chart makes no sense, but the blue is September relative to June, and it just shows trending down. So their expectation is that things are weakening. Rates are going to trend lower. Do we put a lot of faith into this? They don't have a crystal ball any more than we do, but it's the wisdom of crowds, a fairly smart crowd. And generally that will give us an idea of the direction of the market. So now we are down to those two meetings, just a couple days before Halloween and then just after Thanksgiving. 87% chance of a cut at the next meeting, and then an 80% chance of another cut after that. So what are we thinking? We're thinking what we thought going into today's meeting, which is there's going to be 3 cuts and they're going to be little quarter point cuts, but the data is going to tell us from here. There's still a lot of time. And what do we got? 40 days, 42 days before the next meeting. A lot can happen. We'll get PCE, CPI, and a jobs report between then and be headed for another jobs report. It'll be interesting because they won't quite have the October jobs report to see if there's continued weakening. Fed funds expectations for the end of 2025 at 3.625. It's basically just a look at the same thing, the dot plot, and this fun little chart we're telling us should have more cuts. So, Jeb, the $24 million question that you as a realtor don't have to deal with 1,000 times a day, but I get, the Fed's going to cut 2 more times this year. So I'm going to wait until then, and they're going to cut lower. So just like Jeb can throw this chart in here and we can see that the markets are expecting this, that is priced in. So the only way rates move lower from where they are today is that they start pricing in more cuts, or maybe some cuts in January,
or the Fed or the spread compresses at all, right? I mean, you can get some sort of move there with that Fed, with the spread tightening without, the expectations changing here, right?
And we've seen some nice tightening in the spread, largely driven by the mechanics of pools of mortgage bonds and the note rate on them. So I wouldn't expect in the next month or two another jump like that unless we had rates drop significantly, which it's all possible. But we have seen the majority of the gains for this year. You and I, Jeb, we're going to have a little talk here because we didn't throw the charts in on it. But B of A, Lance Lambert threw an article out from their economists yesterday, and they're projecting that rates will be higher at the end of the year than now. So anyone looking at this, they're looking at the same information. They see the futures market saying 3.625 for Fed funds at the end of the year, and they say mortgage rates are going to be higher. I think they're crazy, but those are esteemed economists, and that is their expert opinion. A lot of what came today was from that call that, hey, the bigger issue is unemployment. So this chart, the blue line just shows you what's happened from December 22 to today in terms of unemployment going up. The dotted line is the path that we're on, and the orange is where the Fed thinks we're going to end at 4.5. If you dig into the dot plots, that they also throw their projections of what they think unemployment is going to do. They think once it hits 4.5, it's going to be magic and it won't go higher, and it will slowly ease back down to 4.2 over the next couple of years. And if you're them, they've been very right. They've been pretty darn right, Jeb, within 0.25% on the unemployment rate for about 3 years now. So they're not dumb. They're not crazy. Maybe a little bit optimistic, because when you get these inflection points, they generally move quicker than the Fed or any prognosticators think. But this one will be an interesting one to watch. Trueflation, so the other side of that coin, Trueflation jumped. Last week was 2.04, and we're up 0.25%, 2.29. So if you see, this is a jagged little chart here. It bounces around a lot. It's far lower than what CPI and PCE are picking up right now, but still higher than what they would like to see. We're now, what happened this week that Jeb, the Atlanta Fed would spike up over to 3% for their GDP projection? Did anything great?
Retail sales, maybe?
Yeah.
Retail sales.
So that would be about it. But again, early in a quarter, they're always high, and then it converges as they get more data throughout the quarter. What does it mean for interest rates? 6.22 on the 30-year fixed. I think that a 6.1 handle on it yesterday, Jeb, if I remember correctly.
6.12. Yeah.
Yeah. So that is up day over day, and people are confused by that. Well, the Fed cut. Why would rates be up? I had many people ask me, well, can I renegotiate my rate? Jeb, a couple guys that we know, recorded an episode of a podcast today talking about renegotiating a rate and what that means. So we will not go into it today, but next week, if you are interested in rate locks and renegotiations, we did some detail on that. I wanted to show this, Jeb. Let's see what this does. It may. Do we have to take this one away? Remove, add. Oh boy. Okay, there we go. So this is actually the 10-minute or the 5-minute chart for today. So if you see, we started on the 10-year at about 4.02 at the low levels of the day, got down to about 4.01. And just before, you get these weird candles right before Fed announcements. So someone tried to push the yields higher. Fed announcement comes out and everyone liked it. And we were down to 3.99 and everyone's like, ooh, bonds are rallying. This is going to be good for interest rates. And then just slowly marched up throughout the day and kind of stayed there. So this isn't a lot of big movement. I mean, we started the day at 402, 403, and we ended up at 408, 409. But that just gives you an idea. What happened here is the press conference. So the announcement, the dot plots, the market liked and reacted positively. And then he goes out and starts answering questions and they go, ooh, it's not quite as dovish as what we thought from the announcement and the summary of economic projections. So thought that was interesting for you. And it's a little bit different look at that chart than we normally have.
Yeah, and I had something I was going to say there, and I completely lost my train of thought as I started reading through the comments. And maybe it'll come to me here in just a moment. It was related to what you were showing there, and I do not. Oh, so we talked about this maybe last week, Josh. It's not crazy to think that interest rates went up a little bit today based on the market doing exactly what was anticipated, right? So what we've had is essentially the 10-year likes to front run what the Fed is doing. We've talked about it. It's happened previously. Today was a really good example. We saw the 10-year front run. We saw a 3.99 handle yesterday, Josh, on the 10-year, I believe, and then it ended up closing back over 4 again. And then today, similar reaction. The reality is you need some consolidation around this level in order for it to make a move lower and stay lower to some degree, right? Because we've seen interest rates come down from 6.5% to roughly 6%, just over 6%, say 6.1% in a pretty quick period of time, 6 weeks. That's a noticeable move. And so you kind of need interest rates to bounce around here for a little bit of time. Even though none of us want it, we want the lower rate. The reality is this is healthy for the market to be able to see a move go lower and actually stay lower. So, you might disagree with that, Josh, but I think it's
I don't disagree with it at all. We'll just show this real quick. I moved this out to the daily chart, and this is important to look because when we get to these bottom wicks here where you get to 3.99, you can see we almost hit it over here. We almost hit it here. The market is saying, hey, we really need some more weakening before we're going to push below that 3.99 level. This is what Jeb's talking about, this consolidation, these candles in a pretty narrow range between 410 and 40, 399 and 410. That's sort of the market going, we're kind of coiling here going, what's next? So not unexpected to sit here and have some uncertainty ahead of a big move, because we look at the top here as recent as January, that was at 482. That's an 82 basis point drop. That's a pretty big move. If you had bought the 10-year treasury or an ETF that holds long-term treasuries early in the year, you'd be sitting on 20% gains throughout the year. So from that perspective, yeah.
All right. Well, with that, Josh, I'm going to reference the episode. So today we talked about resubmitting a lock, renegotiating your lock. It's actually going to drop on the Educated HomeBuyer podcast, which is on Apple, Spotify, wherever you get your podcasts. Also on YouTube here. It drops on Monday at 5 a.m. Pacific Standard Time. So if you're not following that channel, you should like and subscribe. Turn on the bell notifications so that you can watch it as it comes out. Like our friend, I'm drawing a blank, Josh. Who's our friend that comments on every video?
Cleburne Hastings, Dixieland Production.
Dixieland, there he is, right there. I was standing right in front of my face and I couldn't think of it. So you could be like Dixieland and come in and give us a comment. So we appreciate you for watching and continuing to support
this is Dixieland here with a comment for each channel, and we appreciate that.
Yeah, we love it. Okay, so Derek has a good question. Says, when refinancing a loan, maybe this is a question we've never had, Josh, surprisingly.
I believe it is a question we've never had in 5 years.
Does your PMI stay the same, or does it change with the new loan?
It does not. You are going to get a new mortgage insurance. It could be a new mortgage insurance company. The rates are in a pretty narrow range from one mortgage insurer to another, but it always is helpful for us to price it with all of them, because 0.01, 0.02, it's real money. It could save you $5 or $10 a month, $100 a year. I'd like to have an extra night on the town every year, Jeb. I don't know about you, but other things are going to change. The loan to value can go down. Your credit score can go up or down. So it is going to be based off the risk on the new loan, not the risk on the previous loan. They get one moment in time, one snapshot to measure the risk that you present to the lender and price it accordingly. So a lot of these refis that we're doing now, I have one that the rate, it's for a listener, and the rate movement is nice, but it's not that big. But I think it was like a $200 difference in the monthly payment. But when you factor in the EMI, it's like a $350 savings.
That's real money, baby. Miscellaneous of the whatever is in Vegas saying hello. So appreciate you there. Andre is thanking you for meeting him. So
we had a Zoom. I'm going to go out on a limb here, Jeb, and say, I prefer it when you guys reach out. You have the opportunity to pick Meet or Zoom, and it's much more pleasant to have a little face-to-face, mano-a-mano when we're talking.
I don't disagree with that. Good stuff. Leonardo, hey guys, my loan estimates back in August at 6.25%. If my new build is planned to be built in February of 26, what rate for a VA loan can I expect then? And do you offer paid services to review a LE, a loan estimate, Josh?
So this builder's lender should be punched in the throat for offering you a 6.25 rate a month ago. That should have been definitely under 6 at that point in time. With all of the movement we've seen now, 5.5 with 0 points for a well-qualified veteran borrower. So hopefully they're giving you a huge incentive. They most likely are. So you're not going to be able to shop that. You can do a VA IRL 210 days after your first payment, and hopefully rates would stay and remain low. But they're at least 0.25%, probably closer to 0.375% above the market, depending on exactly when you got that quote. So we don't really have a crystal ball, but I don't necessarily expect rates to be any higher. We could paint a scenario where rates could be higher in February when he's scheduled to close, Jeb, but I would think here or better would be my best guess, which means based off of what they gave you then, 5.75-ish, something along those lines.
Good stuff. Good stuff. All right.
We didn't answer the last question. Do you offer paid services to review an LE? I review LEs, especially during refinance time, all the time, and I can say for free, no cost. If you guys want to send over a Venmo, a tip with a beer, whatever you want, send a Starbucks gift card.
Can you legally take that, Josh?
Can I legally take a beer for reviewing an LE?
No, can you take money for reviewing an LE? I'm asking. Does RESPA allow that?
I don't believe there's any rules around that.
Fair enough.
If I ended up doing the loan, I might have to refund it.
So what I was getting at is you could Venmo me the money, and Josh
and he will go have a beer for me.
That's one step removed, Yeah. So you don't have to worry about Josh.
What I will say is I am not the only good person out there doing loans. I spoke with a listener on Monday, and I looked at it. I'm like, bro, you're in good hands. And the person did the purchase for them like 7 or 8 months ago. And we look at it and I'm like, it's right in the range of where I would do this. You like the guy? He's dealt with you good. You guys are friends. He goes, oh, he's awesome. I'm like, great, you're good. And he just wanted peace of mind. So I was happy to give that to him. The flip side of that, talked to a listener this afternoon, and we're going through it, and he's talking about his 0 point quote. And then we go back through box A, and he goes, well, what is this origination fee? I go, origination fee is bullshit, where someone doesn't have the balls to tell you what they're charging you for a rate, and they'll throw an origination fee on there and telling you they're charging you 0 points. It was a 1 point origination fee. A 1 point origination fee, you may have noticed by the name, is a point. You are paying points. It cannot be 0 points when you're paying a 1 point origination fee, yet there are people who would like to convince you that that is the case.
Stop it. You are so just condescending, Josh. You're so mean to these people. Amanda wants to know about the dot plots, Josh, and how they affect mortgage rates. Do they affect mortgage rates?
Here's how they impacted today, or could have impacted today. I don't, to me, like some people look at this, oh, rates are up on the day after that meeting, and it was basically flat. I would expect, 25 basis points higher or lower, 20 basis points higher or lower before I say there was a big impact. But what I said this morning is what would cause a big move in the market. It would be for those dot plots to be very different than what the market is expecting. The market is expecting a cut today and 2 more cuts. And basically that chart says the Fed believes the same. The Fed is expecting to cut 2 more times unless the jobs market strengthens, unless we get some weakening in inflation and a greater weakening in employment. So from that perspective, the flip side could have been true. If they had come out and said, oh, we don't see that at all, we're going to do 1 cut and we're out, then the market would not have liked that and rates would have shot up. So really, it is just the Fed. They started doing this, what was it, about 5-7 years ago, Jeb, where they do this 4 times a year. It's just to give you some insights into what they're thinking. And the good part about it is the market can sort of recalibrate and say, okay, they're telling us what they're thinking and we're in line. So to me, today they were in line. It doesn't really tell us anything other than what most people are expecting is still the most likely path forward for the rest of the year.
All right. Good. Josh, question here. Willing has a question. I'm just going to paraphrase it and say, if you have a borrower who gambles, they have a history of gambling, can you use the income that they make in order to help them qualify?
So I'm reading it different. Is he saying, can they use the funds?
I know. I didn't. That
well,
question,
they're 2 very different things. The funds to close, it would depend. Let's say you have a $10,000 deposit because you won a 50-50 or a big tournament on FanDuel on Sunday, and you have $10,000. Well, we can show where that came from. So what is a lender worried about when they're saying sourcing and seasoning the funds? It's that you didn't run out to a loan shark and take out a $10,000 loan over the weekend for your closing. So as long as we can document it and show that it wasn't a loan, we can use it for funds to close. Now, can we use it for gains for income? You have to have a 2-year history. So if you've done this all the time, and strangely, Jeb, what you will find for people that gamble enough that they would put it on their tax return, they lose. They lose more than they win. The reason why they put it on their tax return repeatedly year after year is they get their little receipt from going to the slot machine and they show how much money they lost. And then they show I won this money, and it kind of offsets because they're getting that 1099 for their gambling winnings. They want to show their losses to offset it. So very, very rare that you're using gambling winnings as income to qualify.
There you go. Amanda, another follow-up question regarding the dot plots, Josh. So how does one decipher looking at the chart here? We know, are you going back? You're going,
yep.
You're going to do it? Okay. There you go. So like the easy way to look at it, Amanda, is like if you're looking at 2025, the far left of the chart there, the red at say between 4.5 and 4.25, which is essentially where we were, all of those were red. And then you now look and see that there's only one person still there, the blue. Like the blue is today, the red was previous. So you could see that there's more blues on the lower numbers than there were, say, previously, is the easy way to look at it.
So yeah, if those blues were higher up above the red, that would tell you that they're projecting rates to get worse. They're projecting,
and the more
lower.
Blues in a certain box, if you will, so that 3.625 box, because that was kind of the expectation, you can see how many are in there expecting what 2 more cuts this year, which is essentially what the market is now expecting.
And her specific question, more projected cuts means lower rates. We've talked a million times. Fed cuts do not directly lead to lower mortgage rates, but there is a correlation over time. So if they are correct, they're projecting those cuts. If they end up doing what they project, that would mean that mortgage rates are lower.
All right. We've got Jay Homeboy's got a 50,
Jay Homeboy's been MIA for a while. I haven't seen that name in a while.
He's been here, just keeping it quiet. Just doesn't want to say anything until tonight. I got a $50,000 auto loan in April. I've been paying on it aggressively, down under $20,000. Should someone refinance that, or I'm sorry, pay that off if they're planning on refinancing, or how should they go about it?
The only way that it would impact you is if your credit score could be improved. And generally an installment loan, when I see it, when we do a what if analysis, we say, let's pay off this installment loan. It doesn't really have an impact on the scores. So I don't think paying it off would get you a higher score. So the other question then becomes, does that monthly payment prevent you from qualifying? Then if so, you may want to pay it off or refinance it to a smaller payment, as it's a much lower balance now.
All right. We've got Texas Finest. Thank you for being here. Appreciate your videos. Have you researched if during times of recession in the past, do mortgage interest rates tend to be at highs or lows? So let's talk about what typically happens during a recession, right? So a recession means a contraction in the economy. The economy typically slows down. That's what a recession is, right? So how does the government or the Fed stimulate during a recession? What is their goal? Their goal is to, get businesses to spend money, get businesses to borrow money, spend money, make products so that consumers buy goods, essentially picking up inflation, moving the economy along, if you will. How they do that is lowering the Fed funds rate, lowering the borrowing cost at which these businesses borrow money. So typically speaking, during recessions, you see interest rates move lower because the economy needs to be stimulated in order to get it going again. So, at the moment, economy looks to be fairly strong. Doesn't look like a recession's really on the horizon. A year ago, 2 years ago, depending on the data you were looking at, looked like, recession now. Could it happen? I guess it could, but it looks like it might be a ways off just based on where things are at the moment. Josh, any
in simple terms, inflation leads to higher interest rates, and recessions are deflationary. So they generally lead to lower interest rates. So you have this whole idea of stagflation, a stagflationary recession. You see people saying this stuff all the time. It makes me want to vomit, because the only period of time of stagflation we've ever had was the early 80s. And it was very, very, very different than where we're at right now.
All right, good stuff. Josh, if somebody wants to send you an LE, how should they go about doing it?
Send it over to info@theeducatedhomebuyer.com. That is a good way where we can see them, make sure that they don't fall through the cracks. We can run through the numbers, because Leonardo follows up and said the 6 1/4 was with a 1 point paid in points and 15,000 for closing costs. So we don't know what the purchase price is. 15,000 could be high or low, but 6 1/4 with a point. And with it being new construction, I was certainly hoping you were going to tell us they were giving you $15,000. Maybe he's in also 15,000 for closing. Maybe they were giving it to him, but hopefully.
All right, good stuff. Another one, Tracy asking the same, how do I get you to look over my loan renewal doc? So there's a couple of ways. You can go to jebsmith.net/start. You can, ask to speak to a lender. Josh's team will reach out. If you're, or you could email it directly to info@theeducatedhomebuyer.com, or you could just go to theeducatedhomebuyer.com and fill out the information form there, and it all gets to the same place. So it all works.
The good thing about going to either Jeb's forum or the one at the Educated Homebuyer is at the end, you could get a link right to my calendar where you can schedule a good time for us to talk and review it.
There you go. Good stuff. Let's see here. I saw another good question, Josh, or did I not? Okay, here we go. Platinum Black. If he has an offer accepted, but funds are in stocks, how soon should one consider selling those stocks?
How confident are you that they're going to go up? So that's the big question. And how much of a cushion do you have? So sometimes, let's say we're buying a $500,000 house. We need $100,000 for 20% down, and we have $104,000 in our account. I would not want to risk that tomorrow we have Black Tuesday and now your $105,000 becomes $82,000. So unlikely to happen to see that level of volatility. You will have to liquidate any funds that are not like in a money market, and we'll need to do that prior to loan docs. So let's say we would like to have loan documents out about a week before closing, at least a week before closing. So the gamblers among us like to let it ride till the very end because they think it's going to go up, and the conservative among us will move it to cash as soon as they have an offer accepted.
There you go. Good stuff. We got some thinks here from Texas Finest. If you have questions, now's a good time to put them in. While you're doing that, if you find any value in the show, make sure you hit the thumbs up. Consider subscribing if you haven't done so already. Just curious, how many of you actually listen to the podcast? I realize there's a handful of people watching on the podcast channel right now, but the majority of people at the moment are watching from my channel. So how many of you actually watch, say, both channels, or do you just watch one? I'm curious to know. I would think there's definitely overlap. If not, there should be, because it's a deeper dive into topics that you should want to know about, especially if you're here every week looking to learn and educate yourself.
And we're going to be doing some fun stuff. Jeb and I did some project planning today where we're going to have, yes, we did. Yes, we did. We're going to put an educational path together for buyers and refinancers.
Yes, that's, see, my wife and I have conversations like that, and then she says statements like that, like we had this thought today, and I'm like, what?
And she thought you did have the conversation.
And she did. We did. Like, you and I had that conversation, but that completely like left my mind. I completely forgot about that. So yes, you and I did talk about that, and it just essentially what it is there's a lot of people out there looking for information. What we're going to do is create a document that has essentially all the episodes that we've recorded in a format that's easy to find them, because a lot of you guys have questions about, hey, this thing, and it's like, we could answer it here, or you could just go watch the episode and get all the information you need. And so we're trying to create a document that has it all, so that you can just click on that particular episode. It'll take you to the link. It's easy to find and reference, just, to make things a little bit more accessible. All right. Josh, let's see. That's not a question. Here we go. If I plan to refinance and use my own income, can my wife's debt be used against me?
Trick question. Depends on where you live and the type of loan that you're getting. So a conventional loan, Fannie Mae, Freddie Mac, most jumbo stuff, we don't have to worry about spousal debt. If you're in a community property state and you're getting a government loan, FHA, VA, USDA, for some reason, they think the law is different and we should apply spousal debt against you. So your wife could have a 204 credit score and have never paid anyone back in her life, and that won't disqualify you. They're not using the credit score. They're looking for the debts to just make sure that we're counting their debts against you to qualify.
Good stuff. Good stuff. We got a couple people here that listen to both, Josh. Texas Finest is a new listener, and they're staying. So we did something right.
I like it.
We trapped them in the black hole here. You can't get out now. Let's see what we
Amanda listens to both, and she's back with another question for you.
All right, let's answer it. Go ahead.
So I work from home. I'm going to be listing soon. Any thoughts on specifying that I need a 2-hour heads up for showings? Is that viewed negatively by a buyer if she wants to maximize her buyer pool while also protecting her work time?
Not at all. When I have clients that live in homes, because sometimes they're vacant. So when I have clients that are currently occupying a home, I guess is a better way to put it, I always do at least a 2-hour notice in the MLS and the showing instructions, just without even asking my clients. For me, it gives me some time, and it's like, no, they can come right now, then I'll relay that. But I always say at least 2 hours. And I think that's reasonable. And if there's days where you have meetings and or showings aren't, you have small kids, I'm talking to anybody that's listening that this could impact. If you have small kids, you have different things. You know what? As long as you're available to show the property at some point, like, you can't accommodate everyone at every given period of time during the day. But it's good to be open and being willing to work with people. But at the same time, you got life, and you got, things that you have to accomplish. So I don't think anyone expects, hey, as soon as I call, you should give me, well, let me back that up. There are people that expect that, but sane people, logical people don't necessarily expect that. So I think a 2-hour notice is plenty of time. Josh, So John, I'm going to put your question on here. So John, you asked us to explain why the Fed funds rate kind of increased mortgage rates today. So we spent the better part of the first 15 minutes of this episode discussing that question exactly. So if you just go back, watch that, it'll give you all the information you need without going down that same rabbit's hole again. Daniel Pham, my brother co-signed to help my wife and I qualify for a house. He's looking to buy a home now. If we refi, can he qualify for an FHA loan?
You do not have to refi. So unless you bought in the last 12 months, as long as we can show that you have made the mortgage payment out of an account that your brother is not on in a timely manner over the last 12 months, provide that to your brother, whether that's a printout of auto payments from your account, whether it's 12 months canceled checks, we don't have to count it against him. So if you refi and you get him off, then he can absolutely run out and buy FHA, but it probably isn't necessary. You would refi. I'm saying don't do a refi that doesn't benefit you just to get your brother off of it when it may not be necessary.
Yeah, but if it does benefit you, it's a good time to get him off as well. So yeah, good stuff. What do we got?
Maddie's the smartest one of the bunch. She says not only is she subscribed to both channels, she gets notifications on both channels. So she knows what Josh and Jeb are up to at all times.
So Josh, I'm going to ask you a serious question here, an honest question. Do you turn on bell notifications for YouTube channels?
I have never once in my entire life, not one single time. There's not a channel that great to turn it on.
Agreed. I'm the same here. Yeah. In fact, I have all notifications turned off on pretty much everything. In my life.
You can't notify me of anything. I don't care. I don't care.
I'm on all the team apps for my kids' sports and whatever else. Dude, I open these things maybe once every couple days. There's usually 50 to 60 messages in some of these things because I don't want your notification. In fact, if we're on a group chat, any of us, I'm talking to you, Josh, with your wife and my wife, guess what? It's silence, dude. Yeah. I don't get notified. And in fact, I might not even know that you text me because my wife typically responds to all that stuff. So I'm just kind of left in the dark.
I recently, when the new Pixel 10 came out, I got a new phone. And for like a week, I'm like, why? Why is that thing yelling at me? And several apps took it upon themselves when they got reinstalled on the new phone to turn their yap on. To do that. They got silenced real quick.
They'd like to do that. Brian said, I just bought my home less than a month ago. When can I refi?
Another trick question. Depends on the type of loan, and then the type of loan that you're trying to do. FHA and VA, you can do a streamlined refinance, an interest rate reduction refinance with VA, where you don't have to document your income, where you don't have to have an appraisal. To do one of those, you have to have had FHA's 210 days from the close. VA one-upped that and said 210 days after the first payment. So we have these waiting periods before you can do that. But if you did an FHA or a VA and you wanted to refinance into a conventional 3 days later, nothing preventing you from doing that. If you get a conventional loan, you want to refinance 3 days later, nothing preventing you from doing that.
1 day later. I mean, if you want.
Me, the guy who did your loan, I am at risk. There is no prepayment penalty on a qualifying mortgage, which is basically anything FHA, VA, Fannie, Freddie, USDA, all that fun stuff. Most of the loans that 99% of you are taking, there is no prepayment penalty. For me, there was an early payoff penalty because when you're doing a 0-point loan, we're not a charity. We're not doing it for free. We are selling that loan in the secondary market and we are getting paid for that. So if we get paid for a loan and you pay it off in the first 180 days, we have an early payoff penalty. So what I would say is if you think there is an opportunity to refinance that makes sense for you, talk to the person that did the loan. This is very rare that it needs to be paid off within the first 6 months, that an opportunity arises within the first 6 months. I have one right now for a listener of the show. I believe we closed their loan 3 weeks ago, and he sent me a message this morning, and I said, we got to look at this. So if we do the refinance, I'm going to make money. And I'm going to take that money. I'm going to write a check back to the lender that we did the first loan with to pay them back for it. So we end up doing 2 loans for the price of 1, but it's sort of the cost of doing business. It's just the way the industry works. So talk to your lender, give them that opportunity. Hopefully they're willing to work for free the second time, just to keep that relationship and be happy with you.
All right. Another question here. Thoughts on mortgage payment not exceeding 1/4 of your monthly payment. Currently, my rent is more, so I feel like a mortgage is better if it's more than 1/4. So, Josh, any thoughts on this? To each his own.
To each their own. What I can say is it is very, very rare. Less than 1/3 of the time. So I guess it's not that rare. So, but 2/3 of the time, my clients are well above 25%. I would say between 30 and 40 is the most common. Some folks up around 50%. What I can say is when someone's at a 50% debt to income ratio or even higher on a VA or an FHA, there's something going on there. There's additional household income that we can't use to qualify them. So the ratio is higher on paper than it is in the real world. So if you're saying, hey, I think I feel more comfortable making a little bit higher payment, know your numbers, know your budget. We did a whole episode of the podcast on budgeting. Even if you're not going to be a long-term budgeter, 60, 90 days, pencil everything out. Go back and look at your credit card statement, your bank statement, your debit card, everything. See where your money went the last few months, and see what it's going to look like. Have your mortgage advisor go through the tax benefits. Are there any tax benefits for you? If you're buying a $200,000 house and you're married, it's probably not. If you're buying a $750,000 house and you're single, absolutely. So we got to look at a few different things. There's not a hard and fast rule that works for anyone, and anyone who tells you otherwise, I'm looking at you, Dave Ramsey. You don't have to listen to them.
How are you looking at Dave Ramsey? Are you looking at a mirror?
I'm looking at him right there.
Is he watching? Amanda has another question. Josh says, do you need addresses of properties I'm looking at to give me a breakdown of what the payment cost would be at different price points?
Need is a little bit of an aggressive term there. We don't need it, but it is absolutely helpful. We can look at the tax rate, make sure it's not higher or lower. Some states like Texas, it can vary a lot from county to county, from city to city, what those property taxes are going to look like. So it's helpful. It's not strictly necessary, but it's definitely helpful.
All right. Aaron says, locked in a 7.6 ARM a week ago at 5.25%. Do you think recent news I can get a better deal?
The recent news that rates went up today?
Yeah. So here's the thing. Aaron, just playing there. I actually saw a 7.6 ARM the other day. What did I tell you? It was 5%, Josh?
Yeah.
5% on a 7.6. So there are opportunities out there. Just got to know where to look. But yeah, I mean, it's 5.25 still a solid deal. Like, again, it's easy to say don't get greedy, but don't get greedy. Like, listen, you got a solid rate. Take it, move on. As rates move down, if they move down, you can take advantage. Yeah, good stuff.
It's really just, I'm not going to let that one pass. That advice, like I have heard things from people this week that blow my mind. People that days ago said, no, let's lock it. I'm okay. I don't want that rate to go higher. 48 hours later, I saw that rates went lower. What do I have to do to get that lower rate? And well, if I had come back for you, hey, I got some bad news. The market went haywire and the lender is not going to honor your rate lock. In any world, would you be cool with that? So again, watch the episode next Monday. We talk about the terms under which you can renegotiate. There is a cost to the lender for locking an interest rate. It's not as simple as them going, oh, good, we're winning our favor. We get to make more money today. They do have an expense for locking your interest rate and making sure you don't have a higher rate at the closing table than what you budgeted for.
All right. So Joyce asked a question, Josh, and it's something that you and I have not struggled with, but considered. So the question is, do you have an episode on the refi process? It's an eye-opener for those of us who have not experienced it yet. So we have not really done a refi episode on the Educated HomeBuyer channel. I've done many on my main channel, on Jeb Smith channel, but we haven't done one on the Educated HomeBuyer because it's the Educated HomeBuyer. It's not the Educated Homeowner, and it rarely, most people are listening to our podcast are people looking to buy a home.
They're disinterested in us talking about refinances.
They're not really homeowners in most cases. So it's something we've considered. We haven't done it. It may be time to have that conversation, Josh, as an episode. And if it resonates, it resonates. If it doesn't, then it doesn't. And we'll just see where it goes.
So more importantly, Jeb, we'll get to do a first here. I just got Joyce's loan approval like 3 hours ago, and I did not have time to call him. So we're going to tell Joyce through the internet, live, the power of YouTube, that it is approved. It was super clean, very minimal items that we need from you guys, but that's a VA IRRRL. The VA IRRRL is an awesome loan program that is very, very simple, quick, and easy. So should be getting a closing disclosure out for you guys pretty quickly, and hopefully wrapping that thing up for you next week.
So Josh, this is a question. Last year you did 10 for one guy, I think.
It was during COVID. It was
that your most refinance you've ever done for one person?
Definitely the most at one time, and it was unpleasant. Very well qualified borrower, but there are a ton of moving parts trying to line up just one loan for a person that owns 10 properties, but 10 of them at one time. Most lenders will not do 10, so we had to go 5 at one lender, 5 at another lender. So we had to, that underwriter can look and go, okay, here's these 5 and here's what it changes and here's my cash flow. Then we had to basically get the notes, the new notes from all of those, note meaning the actual security instrument that creates the loan, and send it to the other lender and say, hey, we just did these 5. You're not doing them because you'll only do 5. It was difficult, but that was 10 at once. I would say I have another client who owns 7 or 8 properties, and we've probably done all of them 3 or 4 times over the last 20 years. So probably 20 for him.
So back in the day, I've told this story before to you, at least, Josh. I don't know if I've told it. I had a client back in the day when I did loans that owned 70 something properties. It was an absolute nightmare because, like Josh kind of referenced it there, but most lenders won't have more than a certain number of properties with a potential client because the risk of default, right? And so there were banks out there that said, hey, if you have more than 4 loans with us, you can't have any more loans with us. Or if you have 10 loans with us, we won't allow you to have more than 10 loans. And so there's this thing called the Scotsman's Guide, which is still out there today. And these lenders advertise in it. So I would have to go through these lenders and call these people and say, hey, listen, my guy owns 50 properties. He's looking to buy 5 more right now. Can we do the loans? And it was a nightmare. But I'll tell you what's a bigger nightmare is when that dude wanted to refinance because oh my God. I mean, I had an Excel spreadsheet. I probably still have it somewhere that had all of his information on it, all these different properties. And I don't know how many refis I did, but it was a lot. And these were cheap. I was only making 1% on each one. And Josh, these were like
and they were like $120,000.
No, like $300,000 houses. And man, it was so much work for the amount of money I was making, but I did them.
If you're wanting to do that, the key way to do it, I have a buddy who has like 200 houses, and he's in Nebraska. And in Nebraska, they still have community banks. He's got 2 different community banks that once he gets 10 of them, they will make him 1 blanket loan across all 10 of those.
That's smart,
so
yeah.
With his 200 properties, he's got like 20 loans, which is still a lot of loans.
All right, there you go. Josh, still waiting for you to reply to my email about no income verification loan.
There are, for those of you out there who think that they don't do that anymore, there are no income, no asset loans. There are a handful of lenders who are able to do that. I'm at a loss, and I'm about ready to just stop. I'm just about ready to just stop, Jeb. Like this is the shit that I've been dealing with all week again. Yes, I don't have anything left, Jeb.
so all right. So 200 houses in Nebraska is like 3 houses in SoCal. Yeah, I mean, I think those are probably 100 low hundreds, right? 150, $200,000 homes, Josh. 200 of them. That's a pretty big portfolio. How's that? $40 million worth of real estate or something crazy out there at 200 grand. Yeah. All right. 57 minutes on, where are we at? Let's see here. I think it might be that time. If you find any value tonight, make sure you hit that thumbs up. Till next time, buy right, borrow smart, build wealth. Adios.
Amigos.